Hello, David. How are you doing?
Daniel, can you hear me okay?
Perfect.
Excellent.
Yeah, let's see. How many do we have registered today? We usually get about 50% of registered people attending. We have 149 people registered.
Oh, wow. It's a big number.
Yeah, I'm lamenting the fact that it's trending downwards. So it used to be around 300 or so
Oh,
a year and a half ago.
See, I have no concept of how many. Well, it makes sense. It's a big company.
It is a big company. We're not allowed to advertise within the company. It's all word of mouth. So actually, starting today, I'm going to start asking people to, hey, go invite a friend. There's a lot of people out here in this company that would probably really appreciate this club. They just haven't heard about it.
That's interesting.
Hello, Jitendra. Hope you guys are doing well.
So Daniel,
Gene and Ruben.
I take it you'll want me to share my screen at some point.
Yeah. Okay. Unless you want me to drive the slides, but it's usually better.
Yeah, maybe I can try that now. Make sure I get it right before we get going.
Okay. And I will happily monitor the chat for you, so you don't have to monitor it.
Okay.
And I'll pick out the on-topic questions, which they mostly all are. And I can either judiciously interrupt you or save them till the end.
Sounds good.
I'm sorry, Jitendra, I cut you off.
No worries.
Saying hi.
Can you see? I'm sorry.
Perfect. Looks perfect.
Multiple people. So I just.
Sorry. Yeah. No, your screen looks perfect, David.
Okay. No worries.
You see it just fine.
Sorry, Daniel. I was just trying to unmute myself before I could say something.
Oh yeah.
Well, glad to be back. I was on sabbatical, and then COVID hit me also, so kind of put me out of the game for a while.
How are you feeling now?
Getting better. Yeah,
getting better. Okay.
Yeah, improving.
Yeah, COVID's making the rounds again. I'm looking forward to getting it again.
Probably.
I actually did this meeting with COVID. I was still here. It was not fun for me.
That would not be fun.
Yeah, I don't think I had it. I had Omicron and I didn't get it as bad as some people did, but still didn't feel great.
Yeah, at some point, I imagine mostly everybody will have had it. So.
Yeah. All right, we've got 10 people in the room. We'll see if more join. We originally started putting this on Zoom because we have some people that are retiring that still want to be part of the club. And some people that have legitimately moved away from the company and still want to be part of the club. And otherwise, it would be on Microsoft Teams. I think that is part of the reason why our numbers have gone down, because Intel is used to using Microsoft Teams internally.
Gotcha.
Suppose I could open it up while we're waiting for people to come in to anybody planning anything interesting this weekend? Or does anybody, always an open topic, does anybody have a real estate deal they're working on and want to share?
There you
go. We actually had our first guests to our Airbnb, and it was everything I expected. So, I mean, it went over well. We gave each other good reviews. People were apparently going in and out at around 2 a.m. and there was a fair mess to be picked up afterwards. So it was about what I expected. But all in all, the cleaning people took care of it, and we have another guest coming this weekend.
That's cool. don't have any Airbnbs, but I stay in a lot of Airbnbs or VRBO or whatever. Yeah.
My CPA said that since I'm still a W-2 employee, that an Airbnb would actually help my tax situation quite a bit. I'd get a lot of write-offs from it. And so I've got one Airbnb currently, looking to get more, but I'm also just kind of waiting right now with the current economy before I do that. And I want to get really good at running the one that we currently have.
No, it's definitely profitable for most folks.
All right, we've got
Hey,
27. Hey,
Daniel, just a quick question. So,
yes.
I've been attending many of your sessions. So, with respect to understanding real estate and, getting more deep knowledge, because in future, if you want to buy any estate, do you have any kind of real estate license, or did you study anything apart, from your own study? Like, is there a dedicated website or a course you did?
Oh gosh, I'm a perpetual learner. I don't really go and get licenses, to be honest.
Okay.
There are legal obligations to go along with them, and fees and things like that. And honestly, there's a huge more information than anyone could ever absorb online.
Right.
So some of the places that I went to, first of all, Bigger Pockets is a great community. There is a person on Udemy called Justin Kivel who creates courses on how to use Excel to underwrite apartment complexes. And I learned a ton from him. His courses are better than some of the $1,000 courses I've seen out there. And I just wait for a Udemy sale and I get them for like $15.
Okay.
And they're worth 100 times that probably.
Okay.
And so I also go to accountingcoach.com. It's $99. You get a lifetime membership there, and you can read all about accounting basics. I've got a whole bunch of books on accounting that I personally like. I'm the type that likes accounting. In terms of real estate, I listen to a lot of podcasts. The Real Estate Syndication Show by Whitney Sewell. He was one of our guests in May of 2020. So you can go to the previous Speakers Hall of Fame and see his talk. He's a syndicator.
Okay.
But I listen to his podcast because he just interviews syndicators every day. Joe Fairless is the Best Ever Real Estate Investing Advice podcast is great. I haven't listened to it as much. Sam Wilson has a podcast called Investing in, I think it's Scaling Commercial Real Estate, I think is the name of his podcast. But there's a lot of good courses that are out there. Go to Udemy and just look up real estate courses. There's a lot of very worthwhile courses there that are not expensive.
Yeah, I'll certainly check that. Thank you. I
Yeah.
took a note of all what you said. Yeah.
I'm kind of a podcast junkie too, so I listen to a lot of real estate podcasts, and you hear people's opinions all the time. It's a great way to educate yourself. All right. I think we're at quorum. We've got 56 people in the room. We're 5 minutes after. So David Van Horn, you're going to talk to us about multiplying your wealth by being your own bank and doing that through note investing.
Yes. So
why don't you introduce yourself and take it away?
Yeah, sure. Thank you for having me. My name's Dave Van Horn, President and CEO of PPR Note Company. But I am going to talk to you today about, how to multiply your wealth by being your own bank, how you can be your own bank personally to build wealth or to build a business, kind of like I did at PPR. So, I'll be going over some strategies and things that I employed myself along the way. But before I get too far into it, I wanted to tell just a quick story about opportunity. When I was 8 years old, my father left my mother with 6 kids. So my mom was a single mom. So I don't know if there's any single parents out there. You can probably relate, but 6 kids is a lot of kids. And when a lot of my friends were, home, asleep in bed, I was up at 4:45 in the morning delivering the Philadelphia Inquirer. And, I didn't mind. Oh, by the way, the Philadelphia Inquirer is a newspaper, in case somebody's wondering. Newspapers are probably almost a thing of the past. But anyhow, I got up early, delivered the paper, made some money, and I did that to buy clothes and books and help my mom out. And so a couple of years later, my mom came to me with a unique opportunity. I had good grades in school, and she said to me, well, I want you to try taking this entrance exam to a college preparatory school down in Delaware. And at first I was like, Mom, you're crazy. We can't afford it. It's far away. All these, excuses. And my mom pretty much tricked me or conned me, whatever you want to say. She was like, don't worry, you won't get in. Just go see how you'll do. And you kind of know where this is going. I go and take this entrance exam and boom, next thing you know, I get a 4-year academic scholarship. All of a sudden I'm in these classes with as few as 8 people, had 3 and 4 hours worth of homework every night, had to wear a 3-piece suit every day, didn't even have clothes. So it was just a crazy thing, but it just put me on this trajectory because it dramatically changed my sphere of influence. So all of a sudden I was surrounded by, wealthier kids, that kind of thing. So it just goes to show you that, I'm a firm believer that there's these opportunities that come to us throughout life, but we have to be able to move upon them. So, I think of, there's a preacher on TV, Joel Osteen, he'll go, are you ready to receive it today? And that's the way I feel about opportunities that come our way. And for me, one of those opportunities was real estate. And another opportunity that was big in my life was the note business. And then, fast forward several years, you could see the difference. I was the only sibling that, completed college, and not saying college is everything, but you get the idea. It just put me on a different trajectory. And then, obviously today, like I said, I'm president and CEO of PPR. We're just, we manage several real estate and mortgage funds. So, got over 35 years of real estate experience. I am married. I'm a dad. I wish I could say these were my kids, but they're not. They're actually my grandkids. I have 2 grown sons, but you get the idea. Enough about me. So one of the things I like to start off saying to folks is we're all in the note business. So, well, first of all, I just want to make sure everybody on this call knows what a note is, right? Years ago, I thought a note was a musical symbol, right? So a note in its simplest form is a promise to pay. Most of the time when I'm talking about notes today, I'm going to be talking about secured notes, mortgages. So I'm referring to notes and mortgages, which is houses, right? But there are all kinds of notes. We're going to get into that a little bit. There's unsecured notes. I invest in a lot of different kinds of notes, especially personally. So I'll get into some of the different things that I do and why I do them. So a lot of times, I'll even ask who in here is in the note business, and believe it or not, most people are. They just don't know it, right? Or they don't think about it. And by that, I mean, they're at the other side of the note business. So a lot of folks have credit card debt, auto debt, medical debt, student loan debt, mortgage debt. And if you're in the US, a lot of people have debt. Trillions and trillions of dollars are the debt. But, I'm just trying to introduce the concept of stepping across the aisle and being on the other side of debt, where, most people don't think about buying debt at a discount, or they don't think about receiving payments. They're more in the opposite mode of where they make payments. So a little bit different concept, but it's really just trying to get people to think more like the bank. And when you think about what the bank does, they have a great marketing machine, and they tell you to park your money with them. And what is the first thing the bank does? They take that money and they move it as fast as they can. In fact, they re-leverage the money and move it as fast as they can. So they're doing exactly the opposite of what they tell us to do. They tell us to put our money in a savings account or whatever that is, right? So wanted to talk briefly about PPR, my company's model of what we do. And we raise private equity capital from high net worth individuals. And we pull that money together, and then we go invest in assets. And the primary asset class that we invest in is non-performing mortgages. Last year, we bought $325 million in non-performing first mortgages. We have a JV partner on the West Coast in Orange County. They also have a trade desk in New York. So we get a lot of access to quite a bit of product. As a business, right now we have 595 million under management. And years ago, we were asset managers. Today, we're more of a capital allocation shop. We still manage some asset classes, but the bulk of what we do pretty much going forward is more allocation of capital. And currently we have 241 million of equity under management. Just to give you, conceptual size of our company and what we do. We only have 27 employees though, so not a lot of employees. But this non-performing loan vertical is the majority of our business. A couple of years ago, it was 100% of our business. Today, it's about 77% of our business. We also do commercial notes. We aggregate and purchase fix and flip loans from hard money originators who lend money to real estate investors on properties to fix them up that a typical bank won't lend on. So we buy a lot of those loans and we invest in them. And then we also buy some commercial notes from banks. Usually these are like $1 to $10 million range. And they're typically construction loans, bridge loans for some commercial real estate opportunities that we do. Now that vertical we use really to regulate our capital and to reduce our cash drag. So a lot of times as we're raising money, we park the money in those assets and they're shorter term assets that we can recapitalize. We can drop those loans on our line of credit to get money to go make large purchases of pools of large mortgages or commercial real estate. That was our third vertical. So we do have some commercial real estate, which is about 17% of our portfolio. So you can kind of get a flavor for the mix of what we do. And the other commercial channels are relatively in the last 2 years. Prior to that, we were strictly in the non-performing loan business. So I wanted to talk about finding leverage, right? OPM, other people's money. And for me, this started early on. I was just I don't want to say just a realtor or just a contractor, but years ago, I was a contractor, I was a realtor, and I was actually taking a course to get my broker's license. And it was an evening course. And the first night of class, I'm sitting there and the teacher comes in and he says, how many people in here have credit cards? And we all raise our hand. And the teacher goes, well, how many people in here buy houses with their credit cards? And all the hands went down. And I'll never forget it. He actually picked up our textbook, which was a pretty large book, and he walks over to the trash can and he throws the textbook in the trash can and says, we won't be needing this tonight. I'll never forget it. And I went home that night and I was telling my wife, I go, honey, I think we might try buying houses with our credit cards. And I remember my wife saying, is that going to affect my ability to go to the supermarket and the mall? I'm like, no, don't worry. That's another credit card. And what was going on back then was, they had just come out with cash advance credit card checks, and they had almost non-existent cash advance fees. And it was when they first came out where you could access cash on your credit cards. Now, I wouldn't recommend doing this today because you could just go get private money or hard money. But back then it was a different scenario. And because I was a contractor, I knew how to fix up properties. And because I was a realtor, I could access deals through the MLS mobile listing system. I just didn't have capital. So all of a sudden I found a way to do that. And I started out, I bought the first property with a credit card. I fixed it up with another credit card. And then I moved the tenant in, and then I refinanced the property, paid the credit cards off. And when you do that, I actually walked away with some tax-free money, the excess, because it was a loan. That's why it's tax-free. And then I still cash flowed, which meant I had an infinite rate of return. And I turned around and I did it again, and I did it again, and I did it again. And eventually, I probably purchased a good 10 or 12 houses that way. Eventually got up to 40 places of my own. But the interesting thing that happened was, a couple of things. One is when you paid them off, they kept upping my limits. So the next thing you know, I had 400,000, 500,000 in access. And, you got to realize this was 30 years ago. You could do quite a bit with that back then. Now, I don't live in the Bay Area. We're not quite that expensive, but, it was very feasible for me to be able to go buy properties and do this. So the other thing that happened was, in a short period of time, the property values jumped up. And next thing you know, I had a couple $1 million in equity. And I was able to put lines of credit on my properties, access that equity, and I became a lender. And I started to lend money to other real estate investors. And I also had more money to do my own real estate deals. So in essence, I created my own equity out of, I don't say thin air. It was, some work and labor and things like that. But I did, build a significant amount of wealth by the time I was about 40 years old. I didn't really have to work in my day job anymore. I had enough cash flow and enough property that I didn't really have to work. Now, I wasn't, super wealthy or anything extravagant, but it is kind of a good feeling to know that you don't have to go to your 9 to 5, right? So, I had a coach in recent years. I'm in a group called Birthing of Giants out of New York, and my coach was Louis Schiff, who was the author of Business Brilliant. I don't know if anybody's ever read that book. It's a great book. But when he was coaching me, he would always ask me the same question. And he said, what leverage can you utilize in your business life or even your personal life in the next 6 to 12 months that'll catapult you? And it was funny, I'm paying him all this money to be my coach. Actually, we're going to be speaking up at MIT in the fall, me and Louis. But the interesting thing was he kept asking this same question every 6 months. He'd be like, all right, what's going to catapult you now? And what's interesting about that is there's all different types of leverage, right? It's really, what's this best leverage that's going to accelerate your real estate investing or your business this year? It is a great question, right? Is it education? Is it people? Is it capital? Is it time? Is it technology? What are the different things we can leverage? And I think it was Tony Robbins that says, we don't lack resources, we lack resourcefulness, which is a great line, right? And I think a lot of us get stuck in that. But for me, early on, I was trading time for money. In fact, I just thought, well, I'll work 2 jobs, right? Well, I was married and had 2 kids, and you can only work so much. But really, things didn't really start to take off for me. So I figured out ways to leverage things and eventually leverage other people's money. And in the beginning, I was leveraging the bank's money, obviously through credit cards and regular mortgages and things like that. But then I was able to leverage my equity, and then I was able to leverage other people's money. And when I look at PPR right now, we're approaching, 250 million in private equity. We're kind of like our own bank at some point. We have a unique advantage where we're not dependent strictly on institutional capital. We can raise significant capital pretty quickly ourselves. So it does give you a unique ability and a unique advantage out there. So another concept I wanted to float out there was the concept of investing intentionally. And I would think back to my first property, it was a duplex that had a little piece of ground behind it. I eventually built some commercial garages. Believe it or not, I used credit cards to build the garages. And it more than doubled the value of the property, right? And, a lot of times, I'm a firm believer in this highest and best use of your real estate. But early on, I did some things that were different that I didn't necessarily pay much attention to at the time, but it's an important difference. I didn't, when I got my first rental property that I lived in after I first got married, I didn't get the most expensive property. I actually got a property that wasn't that expensive. My son at the time wasn't in school, and I did that to save money. And then I bought the duplex, and I didn't necessarily buy the most expensive property I could buy. I bought a property that would be a good rental in the future. And I lived there for a few years, fixed it up, right? And then moved to the next property. And I think about the first 3 properties that I lived in, all became rental properties later, and one became an actual business. So that's what I mean by trying to invest intentionally. I don't believe the average person does that, especially with their primary residence. Now, sometimes you'll hear of people today where they're house hacking, or they're doing something a little bit different. Airbnb is an example. We were just touching on that. It's a great idea. It's really not a new idea. What's kind of funny about Airbnb, it's really my grandmother's boarding house meets the internet, right? So it's not necessarily a new concept. It's just much easier to pull it off and do it, right? So, but another way of investing intentionally, I had a really good friend who was a builder, and he had a 13-lot subdivision. And one of the things he did was he built the sample house. he furnished it, which meant all that was a deduction. And then he, sells out about half the development. And then he moves into the sample house, him and his wife and his son. And they lived there for about 2 years or so. And then they finished out the development. They sold all the other lots, the other 12 lots. And guess what he did? He went in and he sold the sample house. So think about it. He basically built it for next to nothing. He furnished it as a write-off. He lives in it. And then when he sells it, because he lived there 2 of the last 5 years, he can have $500,000 gain and pay no tax, right? That's the kind of concept I mean by investing intentionally. And I think the majority of us don't really do that. We just go and emotionally buy a house because we like it, and we're not necessarily thinking of it as an investment. But if you do switch your mindset to investing intentionally, those couple properties that you live in, especially if you can buy a property where the mortgage payment's less than rent in the area, it can be very beneficial for you to hold that property later on. And it may take you an extra year or so to save up extra money before you can move into the next property, but it's going to double or triple your net worth. You just don't realize how much impact that has down the road. So it's a good strategy if you can employ it. So why invest in notes, right? No toilets, no tenants, no inspections, no contractors. And you know what they say about contractors? They're worse than the tenants. And I know that because I was one. So there's a lot of advantages to notes, right? You have passive cash flow, which is obvious. Volume and control, right? Well, banks figured this out a long time ago. If you think about Bank of America, would they rather have 30 million properties or 30 million mortgages, right? They'd rather have 30 million mortgages, easier to manage. Notes are profitable in various market conditions, right? You have collateral. This is one of the things that attracted me the most. Years ago, I used to trade options, right? And there's just no collateral in the market. And when I discovered that I could buy, notes at a discount with a high yield with collateral, it kind of blew my mind. I was like, this is it. It kind of became the holy grail for me because I had this one component, collateral, that I just didn't have in other areas. And notes are versatile. You can flip a note, you can borrow against a note, you can rehab the note. You can sell a partial of a note. There's a lot of flexibility of things you can do with notes that are an interesting thing to have in your portfolio. And then also socially conscious investing. So by that, I mean, we do a lot of good work with our note business, right? We can keep people in their homes, save their houses, rework their mortgages to lower their payments, extend their terms, and we can also get homes fixed up and back into the community. So there's a lot of good that you can do in the note business as well. So there's all kinds of types of notes, right? You have performing and non-performing. This is a real simple definition. They're either paying or they're not, right? And you have residential and commercial, which I touched on. Most of the residentials 1 to 4 family, and the commercials pretty much everything else. And then you have secured and unsecured. And unsecured is things like credit card debt is unsecured. Sometimes you'll see business loans against receivables. Although they're secured to receivables, they really act like unsecured because by the time you were to pursue them, there could theoretically be nothing there as for collateral. And then you have first liens and junior liens, right? And really, just if you're going to get into investing in these, just be aware that there's a lot of differences in the way you do due diligence, the way that they're sold, the way that they're bought. And if you're going to venture into the note business, I do recommend, shadowing somebody or getting somebody to partner with that already knows what they're doing. I don't want to see anybody lose any money or anything. Success leaves clues. There's plenty of people that do the business that you could follow, so to speak. So where do you find these notes, right? There's online sources, there's note brokers and note funds like ours, right? There's loan exchanges where notes are sold. Banks and servicing companies sell notes, private sellers sell notes, government agencies. We buy a lot of assets from HUD, for example. So there's a lot of different places to buy loans or invest in loans. Some of the online sources, I mean, you can even invest in parts of a note. I'm sure you've seen all types of different crowdfunding sites. I can think of at least a dozen or so, half a dozen or so, plenty of places where you can go invest in notes online. So one of the things about goals, especially for me early on. You know, it was funny back when I first started investing in real estate. My goal was to buy one property a year, right? I had my day job and I was selling real estate on nights and weekends, and I was using the real estate money to invest. And I was like, you know, my goal is to buy one house a year. And then my goal changed. It became, I wanted to get 20 houses free and clear. That was my goal. So I don't know if anybody on this call can relate to that, where, hey, my goal is to buy one house a year and get them all paid off, pay down my debt, and then live happily ever after, so to speak. And then my goal changed again, and I wanted to have 100 properties, right? And then it became 100 notes, right? And then, you know, now I want 100 multifamily complexes, right? So all the time it keeps changing. But, you know, I was recently telling my oldest grandson that the story of that there's really only one goal that you should be thinking about, and that's to get as much passive income as possible by retirement age at the latest, and to have as much tax-free or tax advantaged as you can. So it's kind of like the sooner you get to financial independence through passive investments, the sooner you'll win the freedom to decide how you can use your time. And, you know, for many folks, success is happiness, and happiness is this freedom of time for a lot of people to do what you want, when you want, where you want, with whoever you want. That's pretty much what you see a lot of people thinking. And, you know, today, my goal personally is to be as passive as I can, to eventually be totally passive. Now, that's easier said than done, especially when you're running a company and things like that. But it is still my goal. And even though as I get older, I'm not as active, in the last year or so, I liquidated a lot of property and have purposely been doing certain things that are not normal to what I was, to the type of investor I used to be. Because for many years, I was in this accumulation mode. And then now I'm more in a preservation mode. And a lot of what I do today is to benefit my wife or my children, because I want to make things easier for them, not harder. And if I just continued on in accumulation mode, I could, in theory, make things pretty complicated for those guys if I wasn't around. So a lot of what I do today is geared towards the folks that I hope to leave a lot of this to, but I don't want to leave it to them where it's burdensome. So my goals have changed dramatically over the years. So here's a picture of one of my former properties when I was actively investing. So you can kind of see what active investing can entail sometimes. I don't know if my wife wants to have to worry about clearing out the back of this property. She probably doesn't. So, you know, there's definitely, with passive investing, the biggest problem for many investors like myself is being able to have the time to analyze, perform diligence, and then trust the operators that we invest in, you know. But I think one of the advantages of what my company's trying to do is to handle a lot of that, especially in this asset class, for our investors, including myself and my family and friends. I mean, we all invest in PPR as well. But even passive investing involves time, energy, paperwork. But like I said, I'm doing most of that for my heirs and things. So, you know, if you are a high income earner, you're trying to escape your job someday, creating this passive income that exceeds your earned income, which, by the way, is your highest taxed income, you know, pretty much allows you to do that, right? So, but there is a lot of advantages to passive real estate fund investing once you do find an operator that you're comfortable with, that kind of thing, because that is a big caveat to it, right? But it is totally passive. It's mailbox money. It's scalable. You can keep your money working. Some funds have low minimums and compounding options, and you know, sometimes there's liquidity. You know, you can have shorter terms that are more liquid. You typically have limited liability when you're in a fund. You also have privacy, anonymity. You get to take advantage of their professional management, their experience. They also have pooled buying power, and they usually have better resources and sourcing. So a lot of advantages, including diversification too, right? So you can invest in, instead of investing in one note, you can invest in a pool of mortgages, and your investment's well diversified throughout the country, that kind of thing. So there can be a lot of advantages to it. So HELOCs. So just so everybody knows, that's a home equity line of credit. And I utilized HELOCs quite a bit through the years to really build a lot of wealth for myself. I'll be straight up with you. And, it's just by having the ability to utilize my equity. Now, there is a catch. You do have to be disciplined, right? And I never used the line of credit on a property to, go to Vegas and just gamble for the weekend or anything. But a good question, and an old investor asked me one time that got me thinking was, he said to me, he goes, what's the rate of return of the equity in your house or your real estate? And you think about it for a minute, you're like, I don't know. Well, the answer is it's zero, right? And it did get me thinking. And one of the things that happened for me, you know how I mentioned all of a sudden my properties kept going up in value and I had a couple $1 million in equity. So I'll give you a quick example of that. For over the years, there was points where I got 2 million and 3 million in equity, and then it just kept growing. And if I hadn't accessed that, I wouldn't have anywhere near the wealth that I have today. And when I think of my parents and grandparents, they would have never done that. They would never touch, the equity in their property, that kind of thing. But for me, once I got to a couple $1 million in equity, I put, at one point, I had 11 home equity lines of credit on various properties, and I became a lender. Well, think about, let's take $2 million. If I can borrow 80% of that, that's 1.6 million that I could lend out as a hard money lender. I might be borrowing that money at 4 or 5% and lending it out at 15 and things like that, or 12% in points. I can make an easy 10% spread there. And when you make 10% on 1.6 million, that's 160,000 a year. Well, in my area at the time, I could buy a house free and clear for 160,000. So you can imagine if I didn't access my equity and invested in properties or lending, how much I would have lost. Think about, I could have, over a 20-year period, I could have bought 20 properties free and clear by utilizing my equity, just by being a lender to, safely lend money on fix and flip houses. So would have been a huge opportunity cost for me over the years, looking back, if I hadn't done any of that. It would have been unbelievably difference from where I'm at today, from where I would have been if I didn't do that. Now there is another component. Years ago, I bet you it's 25 years ago now, this gal was a real estate attorney, and she was teaching a course that I was taking, and she brought up the topic of asset protection through debt and liquidity. And this is another play that I would do with my HELOCs. And by asset protection, I'll just use a simple numbers just to clarify the point. If I had a property that was $500,000 and I only owed $100,000 on it, there's $400,000 of equity there. If I were to be in a lawsuit, and if that property was in my personal name, especially on my primary residence, for example, that $400,000 is exposed in most states. So what she was advising was, hey, take out a line of credit, whether you use it or not, because you can get a line of credit for almost no cost, and they'll typically lend you up to about 90% of the value, combined value of your mortgages, right? So in this case, I would have been able to get a second mortgage, and it would have put my total debt on record at the courthouse at $450. So if somebody went to sue me, for example, they would look at the courthouse and say, hey, Dave owes $450,000 against this $500,000 property. But here's what they don't know. I might only have a zero balance on that. I just have access to the other 350,000, right? So that is what it's called, asset protection through debt. Now, a lot of lawyers won't tell you about that because they can't figure out a way to make a fee on that. But anyhow, so no offense to any attorneys on the call. But the other thing is liquidity. So God forbid I get terminally ill. I have, lung cancer, and I'm out of work 9 months. And I have this property that's $500,000. I owe $100,000. Well, if I go down to the bank and I say, I just want to live in my home for my final days, they would go, you can't get a loan. You don't have a job. But if I had my home equity line of credit in place, I could actually access that money and live off that for whatever. So I'd have liquidity. So that's what I mean by asset protection and through debt and liquidity. If you take nothing else from this call, it is a good strategy to utilize that. Now you should be disciplined. I'm not saying access the equity and go do something, willy-nilly with that money or anything. So, but HELOCs are important. Next is assets paying liabilities. So, a lot of times people will say we make money when we buy, but it also matters very much how we pay for things. So for one is I used to use my HELOCs to accelerate debt pay down. So there is a technique where you can access your home equity line of credit and send a payment, write yourself a home equity line of credit check to your first mortgage, and say you pay, $20,000 or $50,000 from your second mortgage to pay down your first. And then what a lot of people will do is they'll drop their paycheck on the line of credit. And then if they have any bills come up, they pay it out of their line of credit. Now, these are people that are disciplined, might have some reserves set aside, but it is a great strategy of maximizing your cash flows, because a lot of us just put money in the bank and we wait for the first of the month for when the bills are due or something. Meanwhile, our money's just sitting idle there all throughout the year. Well, by utilizing these, they call them sweep accounts. By utilizing sweep accounts, you could pay down a 30-year mortgage in about 12 to 15 years just by the way you manage your cash flow, right? I didn't say send extra money. I just said the way you manage your cash flow. So it is something to look into if that interests you in paying down debt in an accelerated way. The other thing you can do is you can use your assets to pay for your liabilities. So I'll give you 2 quick examples. I had a good friend who was putting an addition on his house. And I think at the time it was, let's call it $100,000. And I said, well, why don't you borrow additional and buy an asset? And then the asset could pay the payment. And that's what he did. He was a buddy of mine who bought a reperforming mortgage. He used the payment from the reperforming mortgage to pay the line of credit. And in essence, he got a free addition. So that's a concept for people. They're not used to normally thinking about it. I know if I were to get my wife a new, Mercedes or something, I'd be looking at what investment could I get that the investment would throw off enough cash flow to pay her payment. That's kind of the way I've been thinking my whole life, which is probably not normal. But the other thing is, so my youngest son, when he was going to college, we did a similar method where college only cost him about 1/3 by us doing this. So he, when it came time for him to go to school, he said, Dad, are you just going to write a check? And I was like, no, that's not how we're going to do it. I said, you're going to take out a student loan. In fact, I had his mom take out a student loan. And what we did was we took that money and we kept our money invested. And then we also were able to go buy, when it came time to pay back the student loan, my son came to me, he goes, oh, I thought you were going to show me how to do this. I said, yeah, I'm going to show you how to pay it back. And what we did was we bought a reperforming junior lien, and the payment from the junior lien paid the payment on the student loan. In fact, the junior lien had about 12 years of payments, and he had a 10-year student loan. But what was neat about it is you can buy a junior lien at about 35, 40 cents on the dollar. So you're basically paying off your student loans at 1/3 of the money or so. So what was interesting is we were able to pay for college for my son for about 1/3 of the money. Now, my son since got married to a gal that he met in college, and his father-in-law paid the full freight of college, and he's telling his father-in-law, hey, I went to the same school and I paid 1/3 of the money, and here's how we did it. So that went over like a lead balloon a little bit, but you get the idea. So a lot of it is how we pay for stuff. And a lot of people don't really think about their assets paying their liabilities. So yeah, and another strategy we used to utilize was some of the wealthier clients I have, especially where they'll access cash value out of a life insurance policy, invest that money. When I was 19, I worked for a builder, and the builder built houses with his life insurance. He'd borrow the money out, build a house, flip the house, take the profits, funnel them back into the policy as best he could. So there is some strategies like that. It's not about what, the insurance policy makes. That's most of the people I know aren't even looking at that. They're looking at the money they pull out of it, what the return of that is, where they can get, low cost or cheaper insurance by investing that money on a regular basis. So just a little bit different strategy there with your assets paying your liabilities and things. So ways to get started in notes, right? You have performing notes. They're probably one of the easier ways to get started. Note funds obviously are not usually difficult to do. Non-performing notes, that's a different subject. That's a lot of compliance, especially in residential. Definitely not for the faint of heart. You do need to know what you're doing. Seller financing, that was one of the ways I started in notes with seller financing. In fact, I recently had sold my last 14 properties and I held like a $400,000 mortgage for the guy who paid me for a few years and then has since paid me off. But and then private or hard money is another way to, like I said, make real high returns. They typically last, 8 to 12 months, but the rates are pretty high. Even today, they're 10, 12%, sometimes points involved, which is an extra percent or two. So you can make pretty good money on private lending. I used to do not only my home equity lines of credit, but even my self-directed IRA accounts. I would utilize them to lend money out as well. And the seller financing is a cool strategy too, because you're able to cash flow off properties you no longer own, which is kind of neat, right? And then peer-to-peer lending or receivables. I mentioned that. I do some of that. One of the things I'm doing lately personally is I'm doing a lot of supply chain gap lending, mostly on medical supplies. We were doing everything from, believe it or not, formula, mask, first aid kits to Ukraine. We're doing medical gowns, all kinds of lending on short-term lending on supply chain gaps, which have been making pretty crazy returns lately. So there's a lot of ways you can do the note business just to get your mind thinking. And the other thing I want to point out is to, some of the ways that I invest personally is I gear things towards short-term, midterm, and long-term. I do look at tax favored versus not tax favored. And then I also look at, if I invest with regular money, a lot of times I'm trying to get assets that depreciate. So I invest in not just real estate or multifamily. I also invest in, ATM machines. There's also oil and gas machinery that has a lot of depreciation to it. So there's a lot of ways to invest to offset your earned income. And then my thing is I like to invest in what I know. So for me, it's always real estate related or lending related, sometimes insurance related. I used to have an insurance license over the years a couple of times. So I usually invest in what I know. And I'll give you an example of that. I had a buddy that was a heating and air conditioning guy. And I said to him one time at lunch, I said, have you ever thought about financing the installation of the heating and air conditioning units? And he goes, oh, you can do that? I was like, yeah, you can do that. And what he was able to do was, think about that. He's able to get a deposit from people that usually covers the cost of the unit or close to it. And then he's financing the labor. And then now he's making a spread. So he also gets more service contracts from it. So it increases the value of his business, right? So it's just like, he never thought that, he thought he had to do mortgages because that's what Dave does. No, you can invest in what you know, right? And I had another good friend out of Dallas who was a dentist. And I said, I was out with him and his father one day at lunch. I said, have you ever thought of financing dental work? And he goes, well, there's a company that does that. I go, yeah, I know. Did you ever think of owning one? And what he did was he got together with an orthodontist and they used their retirement accounts to set up the ownership of this company. And a couple of years ago, I saw him and he goes, Dave, you're not going to believe this. The finance company that we started for the dental work is worth more than my dental practice today. So that just goes to show you that, you can invest in what you know and you can do very well. And so no one says you have to do the note business, the way Dave does it. I mean, you could do lending to your landscaper for, grasshoppers to cut grass, so there's all kinds of ways to utilize the note business. So, for those of you who don't know already, I have published a book through Bigger Pockets called Real Estate Note Investing. If you're interested in potentially learning more about this, I'm sure you can easily access this somewhere. Really just, if you want to find out more, you could go to pprnoteco.com. I would like to open it up to some questions if we have time. I don't know how under or over I am at this point. Maybe Daniel can help me.
You're doing great. You've got 15 minutes left, so we can have a good question and answer time.
That's awesome. Because I did cover a lot of topics. I kind of wanted to do that and hold the questions to the end because I wanted to float out some of these different things that I did personally over the years. or through my personal life or business life, to just to give you guys thinking, and then hopefully that could spur some questions for some folks.
All right. So I usually start from the top and work my way down, but Zach has such a good question here. How on earth do you keep all of these straight?
You know, it's funny you say that. Well, you could segregate the businesses. I know when I had, you know, years ago, I was a property manager as well. I had owned a title company. I had done a lot of things, but you could separate your businesses. But he is right. I do have a lot of entities, probably around 50-ish entity-wise. But I am trying to shrink that as I get older and simplify things. But yes, you segregate things by bank accounts and credit cards. And, you know, I had a property manager, even though that's how you know you arrived when, you know, think about it. Years ago, I was a painting contractor. Well, when you hire the trade that you did, that's when you know you arrived, right? I was a property manager and I hired a property manager probably for a good 20 years, and she was phenomenal. But as I've gotten older, I don't even like when my property manager calls me, because it's never to wish me happy birthday or anything. It's always something crazy. And today I'm much more comfortable, you know, being a limited partner or a general partner in like multifamily syndications of larger complexes, because I don't get the maintenance calls. I don't get the management calls. You know, I'm just a capital typically. So it's much easier today. And sometimes I'm a signer, you know, where I'll be a person on the balance sheet signing on the loan or something. So it's a much more relaxed time nowadays. But you are correct. It was pretty crazy there for a while. And that's why my wife's kind of on me to simplify things. It's a great question, though.
Ashish has a question here. What concerns do you have for investing in notes in our current environment of high inflation, rising rates, and plateauing / declining property prices?
Yeah, no, these are great questions. We get these same questions, especially recently. We're always getting the inflation question. We're always getting the, you know, about the economy, that kind of thing. Now, we've been around through several markets. Like I said, I've been investing over 35 years. So I've seen a lot of different markets. What's unique about, you know, this potential, I'll call it a technical recession we may be in, or, you know, we're finding out now, right? But the one difference here that's unusual is that there's low unemployment. And in the last recession, for example, unemployment was high. And in the non-performing loan business, that if you were to ask me what is the one leading economic driver for the non-performing loan business, it's unemployment. So when unemployment's high, you know, defaulted mortgages they're actually abundant, they're cheaper. So for us, but we you know, what happens is your strategies shift. We make money in all cycles. We're just coming out of a very up market for notes, right? So notes are in direct correlation to real estate values, and real estate values have been up, right? So the cost of notes have been up, margins have been relatively thin. And now what we're starting to see is things are opening up as they've raised the interest rates. Now, you did make a very intelligent observation, and I'll point this out. At the end of last year, like I said, last year we bought 325 million of non-performing loans. In the first quarter of this year, we bought almost none. We just bought a couple small trades, and it was strategic to do that. And you know why? It was because the rates went up dramatically and the market hadn't adjusted yet. And we purposely held back and didn't purchase. Now, about 2 weeks ago, we just settled on 73 million in loans, and we're getting ready to do some more trades, but it's very strategic. And it's some of the reasons that we've done more multifamily, and some of the reasons sometimes we buy more commercial notes. We actually have a CIO who's a market watch forecaster on staff. And one of the things we do is we're constantly watching the market. And that's how we have an allocation model. We have investment committee. We basically, you know, invest in different verticals based on what the market's doing. But I think real estate overall, it's still supply and demand, and we're short over 5 million units. So I don't know that the real estate values are, you know, it might calm down. That's what the interest rate hikes are going to do. It's going to kind of calm things down. But I don't know that the residential real estate market's going to get hit dramatically, because there's such a big shortage in housing, especially in affordable housing. In the multifamily that we do, like we don't do Class A space, for example, and they're starting to feel some vacancy. We only like that, you know, C and B class. because that is the affordable housing spot. That is where the structural shortage is in the US, especially in the emerging markets and growing markets all along the South, the smile, they call it. They're the kind of markets we like because there is going to be so much population movement, so much economic growth. Take a place like Austin, it's insane. I'm actually trying to live there half the year, but some of these markets are incredible. But no, I think real estate's going to be good for the while. I think if there is any kind of dramatic shift, it'll, hey, could there be something crazy with oil or Ukraine? For the most part, we think the Fed's going to do their adjustments, July and September, and hopefully that's it, unless something crazy happens. I think that should be it. But no, we're pretty optimistic. I think we're still going to be aggressively buying throughout the year. The other thing is when we buy non-performing loans, it's almost like dollar cost averaging. So typically it's a 36-month runway, and we'll invest maybe 50, 60 million in private equity with our JV partner, and then we'll use institutional capital with that. But then we're aggregating these purchases, and the purchases are based on the different market conditions. And that's why I said it's like dollar cost averaging. And then when we get to about month 12 or 18, we do a securitization, which is like a refinance of the pool of mortgages, and it lowers our cost of capital typically. So our last securitization in January was like 3.1%. So you can see how low the rate was. Now the rates are higher right now, right? So you may not securitize if the rates are high. But typically we'll securitize, take risk off the table, lower our rate, and then we wind down that pool of mortgages over the remaining 18 months. That's a typical cycle for non-performing loans. So it's really like hurry up, buy, and you're getting different pricing as you buy. And then you're going to refi and lower your rate, take your risk off, and then liquidate those assets. So we're pretty dialed into what we're doing with that, though. So not too concerned there. I think now, if there is a recession, that's the other thing. If fortunately or unfortunately, if there's a true recession, the economy tanks, we excel in non-performing loans, and that's still the majority of our business. So that area will be the place to invest if there is a market real downturn,
All right. Trish is asking the question, could you please elaborate on how to use a HELOC to accelerate your debt payments, your debt payout?
There's a guy I don't know if you ever heard of George Antone, who does a pretty good modules on sweep accounts. He's a West Coast guy. He's in the Bay Area, I believe. And a sweep account is really, they actually sell software that does it for you and tells you when to send the money. But it would be like this. If I had, I'll use simple numbers. Say I have, a $500,000 first mortgage, and I have a line of credit for 150,000. And I get a line of credit check for 50 grand, and I send it to pay down the first. And then what I do is I basically use the line of credit like a checking or savings account. I drop my paycheck on the line. Now I can't go below zero, but as I pay down the line of credit, I could send another $50,000 check towards my first mortgage. So it does a couple things. One is interest is calculated differently on those two types of loans. And a lot of people don't realize that. They just look at the interest rate. The other thing is your money is always moving, and it's always paying down some type of debt. It's not sitting in a bank account dormant. So what happens is, say you get paid, I don't know, $5,000 every 2 weeks, you're dropping that paycheck on the line of credit. So you never have to make a payment. Your paycheck acts as the payment when you deposit it on it. And you might say, yeah, but I might need groceries, or I might need a transmission in my car. Well, you could access the line of credit to pay your transmission or pay your groceries. And then you keep dropping your paycheck on the line of credit every 2 weeks. And what it does is you're maximizing the cash flows of your personal finances. We do it with businesses. It's kind of funny, but the average person or a family doesn't. And when you think about it, the average family, they are a little mini business, but they don't really treat it that way. And these sweep accounts are pretty popular in Europe and Australia. They're just not real popular in the US. I don't know why. But you can literally pay down debt in a much accelerated fashion. And you can also do this. You don't necessarily have to have a house and home equity line of credit to do this. I've seen people do it with a car loan and a credit card, where the credit card acts as the HELOC would. And you could pay down credit card debt, or you could pay down student loan debt. It's just another way to accelerate the pay down of debt. I know credit cards give you interest-free money for 28 days, things like that. So there's strategies where I know a lot of contractors used to do that. When I was a contractor, I used to buy a lot of material, and I would put the supply houses would give me a month interest-free, and then I would put it on a credit card where I got frequent flyer miles or whatever, and I could go on vacation for free all the time because we bought so much supply. Or especially if you're building houses or flipping houses, there's a lot of materials. Because I knew a builder that would send his daughter to Europe just on the points from his credit card by the supplies for building. So you can do a lot of neat things with these if you're just a little more strategic, a little more thoughtful. And then I've seen people even take it another step where they have credit cards with different due dates, and they almost get almost another full month of interest free based on, I forget what they have. They call it some kind of date in the credit card where it cuts off, and then they charge interest on the next, like a cycle date. Sometimes people will marry the cycle date with what they're charging. It's kind of, I know I'm going extreme on it, but you can really take it to another level if you really want to, and really manage your cash flows a lot better than most people do today. But yes, definitely look into sweep accounts.
All right, and last question. There's questions about, can you recommend banks that will give you a good rate on your HELOC? And is there any way to get a fixed rate interest HELOC?
Yes, well, there's two types of second mortgages. Typically, some are equity loans, which are like a fixed payment. And then you have equity lines of credit, because this is a great point. Equity lines of credit are usually short term and the rates can fluctuate. Now you might say, well, why do you like that? Well, I didn't really mention this in my talk, but a lot of times I'm marrying my capital to the investment. And I think that's another thing that people overlook sometimes. So I try to marry my short-term money to short-term investments and my long-term money to long-term investments. It probably starts to make sense as I say this though, right? But where people get messed up, I think, is they'll take short-term money and put it in a long-term investment and go, can you believe this thing, adjusted in rate, now I'm screwed, right? Well, that's kind of why that's happening, right? Because they're not necessarily allocating the right capital to the right investment. But there's nothing wrong with equity loans. I've done them on occasion. But the lines of credit, the way the interest is computed, it's very short term. So if I'm keeping it in a short cycle, like a sweep account, or I'm doing another strategy, which is shorter term, I don't really worry about the rate, because I'm only it would be like if I used a line of credit to do a fix and flip deal that's only going to take me 6 months, you might go, well, the interest rate's really high on that. Yeah, but I'm using it for such a short period of time, it's almost negligible. But in those cases, it's probably another thing I figured out over the years was I usually don't like using my HELOCs for real estate deals. And that's what a lot of real estate investors do. And that's what I used to do. And here's why. I had a plumber one time who accessed his line of credit on his primary residence, went to fix up a house in the next county over, and he took a heart attack. It was a buddy of mine it was my plumber actually. And he took a heart attack. He's out of work for like 9 or 10 months. And he jeopardized his own house over it, where he could have just used private money or hard money. And then if that was the case, he could have just given them the house and they wouldn't have done anything to his credit or anything, right? So I prefer to use private money or hard money when I'm doing a real estate deal. And then I use my HELOC money to invest in things like notes and, fix and flip loans, because they're shorter term. And then I don't have all my money in like one deal. I feel it's less risky by marrying my short-term deals to my short-term money, that kind of thing. And it's just safer in my mind, because now I have the best of both worlds. And I can grow my wealth twice as fast, because if I'm using somebody else's money to do my real estate deals and using my money on more liquid, safer investments, my wealth's growing twice as fast, right? And it took me a while to figure that out, but it is a great question, what you're saying.
All right, I have a request of everybody in the group, but before that, let's all take ourselves off of mute and thank David for coming in and dropping a lot of knowledge on us.
Thank you, David.
David, awesome.
Thank you, David.
Thank you.
Thank you.
Thank you very much.
Thank you.
Thank you. Thank you.
All right, and then really quickly, my request is that Intel only allows us to communicate this club via word of mouth. There's no advertising. We use meetup.intel.com, but nobody who hasn't heard of this club ends up finding it unless people ask them to come. So next week, could you, if you've gotten value out of this club, could you invite somebody else to come to this club and to experience the same thing? All right, everybody. Thank you very much, and I hope you have a great weekend.
Awesome. Thank you, Daniel. Take care,
Thanks,
everyone.
Daniel. You
Have a
too.
great weekend.
Thank you, David.
Thank you. Bye-bye.
Bye.